Hi, everybody. This is John O'Legas, and I'm going to be talking about a strategy that's promoted by wealth managers to people who are holding equity compensation, especially employee stock options. The strategy I call is early exercise of your employee stock options, sell and diversify. And in my view, it's a fraud upon the employees. Okay? So who benefits from the strategy of early exercise of your employee stock options, selling of the stock immediately, and diversifying the net residual amounts? The answer is the company benefits, as it receives the remaining time value that is forfeited by the employee to the company. The time value remaining has a value that represents the remaining liability of the company towards the employee, which is eliminated when you exercise. The company also gets early cash flows from being paid the exercise price by the grantee, and they get cash flows from the tax deductions coming from writing off the intrinsic values of the employee stock options upon exercise. The company, as a result, can also use a lower expected time to expiration in their fair value calculations of their options that are issued, thereby lowering the employee stock options accounting expenses against earnings. The wealth managers benefit as they advise using the residual amounts to diversify into products that they sell or manage. Many wealth managers are employed by investment bankers who advise the company, and they have a conflict of interest as to what is good for the company, what is good for the employees. The top executives, that is the CEO and maybe one or two below him, they benefit because most have been instructed by competent advisors that the best strategy is to hold to near expiration, and they generally do so. Not always, because you see some that are exercising early too. They benefit because the early exercises of the other employees lowers the cost of the employee stock options to the company, and the early exercise raises the value of the executive's compensation holdings as benefits flow to the company and the shares increase in value. Who loses from early exercise and sell and diversify? The early exercising employee loses because he or she forfeits the time premium, which is a substantial value in most cases, unless the stock's way up or it's getting close to expiration, or perhaps it has a very low volatility. And they also pay an early compensation tax. Any benefits from diversification are overstated by the wealth managers, as the penalties of early exercises most of the time overwhelm any benefits from diversification. Perhaps they used a deceptive paper by McCain and Kate Thomas called Optimal Exercise of Employee Stock Options and Securities Arbitrations as support for this idea that diversification after you make premature exercise and sell is a valid strategy. Both the employee and the employer lose to the degree that the employee's alignment with the company is eliminated after the stock sale, and that defeats the purpose of the plan. Here are some probabilities that are relevant. It's estimated that 88% of the time, the stock, which starts at 20, will be below 40 after 3 years from the day of grant for stocks with perhaps a 30 volatility. And as for the stock, which is presently 20, the probability is 70%, that it will be less than 30 after 3 years. So most of the time, there's a substantial amount of time value remaining, even though you might have substantial intrinsic value, unless the stock is way, way up or the time is running out or there's a large dividend. Wealth managers have a fiduciary duty to advise risk reduction in concentrated positions. But most of the time, their advice would come when the stock is less than 100% above the exercise price, because of the fact that only 12% of the time will the stock be above 100% above the exercise price after 3 years from the grant. So how is it possible for wealth managers to advise efficient risk reduction most of the time, when their only tool is to make premature exercises, sell stock, and diversify? Even if the time value is near zero, the early payment penalty makes it inefficient. But they advise premature exercises anyway, because of the benefits to the company and themselves. Slides 7 and 8 show the results of early exercises. The penalties to the employee for early exercises of traditional employee stock options are illustrated in red in slide 9. The benefits to the employer are also illustrated in red in slide 10 below. All right, so this is a graph which you may have seen before. It just shows you how the theoretical values of employee stock options change as the stock moves around and as time decreases. And it also separates here the time premium, which is in the brown blocks, from the intrinsic value, which I've separated to show the results of what happens when you exercise and sell. So if you have been granted 1,000 options to buy the stock at 20, when the stock is trading at 20, and you assume a volatility of 30, and you're using a risk-free interest rate of 5%, the expected time to expiration that we're assuming is 6.5, and we're assuming no dividend for the purposes of this graph. These are what the time premiums look like. And so if you have 1,000 options to buy the stock, and these are the assumptions about the stock and the other assumptions, and the stock goes from 20 to 40, you have $20,000 of intrinsic value, but you also have $4,500 of time premium remaining. If you exercise now, you forfeit this $4,500. And you also pay this tax several years early. Okay, and that is essentially a penalty for having to pay that tax several years early. And I contend that the penalty of having to pay this tax several years early, for example, 5 years early or 4 years early, is 5% compounded per year, if not more. But conservatively, I think it's 5% compounded per year. Now this next graph shows merely the same graph as before, except we're using certain different assumptions. The biggest difference here is the assumption about the volatility. We're also assuming a 3% interest rate as opposed to 5%. So, but still, with the lower interest rate suppressing the time premium, the higher volatility has pumped it up such that it's substantially higher than it was in the first graph. And as we can see, at 20, the time premium was about 41% of the underlying stock. and here it is 55%. And as you can see, the time premium decreases as we go. But still, if you exercise early, you're forfeiting that time premium and you're paying an early tax, which has a penalty associated with it too. All right, so here, this slide shows the penalties of early exercises in the red slot. So if you have some employee stock options which have an exercise price of 20 and the market price is 30 and the volatility is 30 and you exercise with 5.5 years to go, you're forfeiting $6,114 in time premium, and there's an early payment, there's an early tax payment of $4,000. Okay, because you're only netting $6,000, and paying that tax 5.5 years early is worth $1,200. So the two penalties are total $7,314 if you exercise when the stock's at 30 and it has an exercise price of 20 with a 30 volatility and 5.5 years to go. So that's quite a lot compared to the little net after-tax proceeds. If the stock's 40 and you're going to net after-tax $12,000, you're still paying a $6,400 penalty in order to make that early exercise. If the stock's 50, it's coming down, the total penalties. And if it's 60, it's coming down even more. But there's still a substantial amount of penalties, half of which is under these circumstances, or from the early tax penalty. Now, when we're using a higher volatility, as we're using in the lower part of this slide, we're still assuming a 20 strike price, different 30, 40, 50, and 60 market values, but we're using a 60 volatility here. And as you can see, if the stock is 40, when you make a premature exercise, giving you the right to buy the stock at 20, the two penalties are forfeiture of the time premium and the penalty for paying the early tax. That's $83.78 when you're netting $12,000 after taxes. And as you can see, with the stock at 60, the intrinsic value is 40. You get to keep 60%, and you pay 40% of that, $40,000, which is $16,000 to the government. That payment with 2.3 years is worth $48,700. So it's worth $2,000, and so the total penalties are worth $48.70 when the stock even is 300% higher than the strike price. So anyway, it shows you what the penalties are to the employees when he makes those early exercises. Now this is going to show you the benefits to the company. All right, we're assuming a 20 exercise price, the same market prices, the same different volatilities, 30 and 60, same years to expiration. But these are the consequences to the company. They receive that time premium that you forfeited. Okay? They also get some cash flows. They get cash flows in the form of you're paying $20,000 to them because they're issuing the shares, and if you sell them, you're selling them into the market. You're not selling them back to the company. So they're getting a cash flow of $20,000, plus they're getting to write off the intrinsic value, which is $10,000 as a compensation expense, and that saves them $4,000, and they effectively get a cash flow of $4,000 because of their write-off. Now, as the stock goes higher, their flow gets higher from taxes, although it stays the same because of the cash exercise price paid, because the exercise price is staying the same. All right, so if you have the right to buy the stock at 20 and you exercise it with 2.5 years to go, you forfeit $23.72 in time value. The company gets a flow of $20,000 plus $16,000, and the early tax flow credit that they get is worth $1,200, $1,900, $2,100, $2,000. On the bottom, we see the same kind of result, except that the time premium forfeited is quite a bit higher because we're using 30 implied 30 volatility as opposed, we're using a 60 in the bottom part, a 60 volatility as opposed to a 30 volatility in the top part. And as you can see, the time values received become greater. Okay, so that is the reason these wealth managers and the companies are out there promoting early exercises. And they make the actual only other strategy to efficiently manage those employee stock options is to hedge them by selling calls, or selling calls and buying some puts. Now, when they have a choice, and in most cases you can't hedge. Most cases the plans allow hedging, but the wealth manager is not going to tell you about it because he doesn't want to get into all of that. It's over his head, to tell you the truth, in most cases. All right? But the company knows that if you hedge, you extend the exercise price, and they don't get the flows and they don't get the time value forfeited to them. Okay? So the wealth managers are out there promoting the interests of the company. All right? So that's the situation, and thank you for listening. I hope you felt that this was informative. Have a good day.